In this video, I want to talk a little bit about asset management ratios. These really speak to the efficiency of the firm and whether or not it's using the assets well. Simple way to think about that is that the money that companies raise from investors, for the most part, goes into investing in assets. And so you see that on the balance sheet. You see on the one side you have assets. On the other side, you have liabilities and equity. So, liabilities, money you raised from debt holders, equity, money for stockholders, and those two are supposed to equal the assets. So, really, these ratios are trying to understand that given that that's what's being done with the money, how well is it generating profit? And kind of gets to the question of whether or not the firm is right sized in terms of its assets. It might be that the firm seems to be generating a lot of sales on not much assets, in which case, even though they are generating a lot of sales, the view may be that you're sort of choking their future opportunities and that you need to invest more, or that they really aren't generating a lot of sales or profits from their asset, in which case they may just be holding way more assets than they need to actually generate that, and some of them are non-productive or low productive. Equity holders care about these measures because they directly impact the return on equity. They also impact just the overall returns, and so debt holders might care as well. And generally, you can't say, oh, there's a right asset management ratio level for every company. It really will vary by industry. Just because some of them are very capital intensive. You go to a manufacturing industry and obviously they need a lot of assets, whereas you go to a services industry and they really don't need a lot of assets. So you can't just look across all industries and compare this and say one's more efficient than the other. Just entirely different business models. So the first of those is the total asset turnover, or really just asset turnover. The formula is simply sales over assets, so sales or revenue, top line number, divided by assets. Think of this as the amount of money that we generate for every dollar of assets we invested in. So in this year, this is how much money we generate for every dollar of assets. Clearly that varies by industry, but it's a very simple and straightforward way of basically saying if you're in the same industry and you generate more sales for every dollar of asset investment than your peers, then that's pretty good. But if you're not, if you're lower than them, then you're not very efficient. So again, sometimes these are called efficiency measures because they really relate to how efficiently you're using your assets. So if your asset turnover is too low, then you might either A, consider divesting or selling underproducing assets, or I've seen this in some companies where it's not necessarily about that they have non-producing assets. They just seem to be overpaying for them. So you can imagine if for whatever reason you guys don't do a good job shopping or negotiating or whatever for your assets, and you're consistently having to pay higher prices for your assets than everybody else, then it's going to cause this ratio to be lower. Again, another kind of efficiency, rather than looking at all assets, it focuses in just on inventory. So that's called the inventory turnover ratio. So that would be your cost of goods for the year, right? Which, if you go and look at your income statement, you usually have revenue and then you have cost of goods. So think of cost of goods as the amount of money you had to spend on inventory over the year divided by inventory. And so if that's high, then what that suggests is that you turn over your inventory fairly frequently throughout the year. So a cost of goods, let's say of 6, would say that you turn your inventory over 6 times a year, or about every 2 months. And so that's good. Having a lower inventory ratio basically says you don't turn your inventory over very often, meaning you don't sell it and replace it with new inventory, and that's bad. And in fact, you can take that inventory turnover and you do 365 divided by the inventory turnover number. So, again, we said as an example 4. If I have an inventory turnover of 4, it means you turned it over 4 times a year. So if we took 365 divided by 4, that'd be about 91. So 91 days, about a quarter of a year, sure enough. So it's just a different way in stating in days, how many days of inventory it takes for you to sell out your inventory, or that you hold it is maybe the better way to think about it before you replace it. You could do that with quarters. You could do that with months, right? You could just say, calculate it in months. And so it's 12. And so you would take, 12 months divided by that and speak that way. There's a lot of different ways you can do this efficiency ratio. Again, the real key there is that inventory is cash that's tied up, sitting on a shelf, waiting to be turned into profits. And inventory has a carrying cost. So in an ideal world, if people would let us and we could get our production and our whatever else we have to do to actually get the inventory, if we could get that to the point to where we could just add inventory the instant that the last a unit sells, we can replace it with another unit all within a day, then we would keep almost no inventory on the shelf at all. As a matter of fact, Amazon's a great example of that. Technically, Amazon anymore, as I understand it, really has no inventory at all. When you go online, place an order, they route that order directly to their supplier, and the supplier either ships it to you or ships it to them to ship to you, however it works. But at the end of the day, they don't hold any inventory. So obviously that puts them in a better situation in terms of having money tied up than somebody that maybe is a grocery store and has to have a bunch of that inventory sitting on a shelf. So if you want to improve your inventory efficiency, again, not entirely clear that you can change your cost of goods. Maybe you could, but even if you did, if you drove down your cost of goods, that would drive down the cost of your inventory over time too, because inventory is booked at the cost, not at the sales value. So really, the only way to improve this is to reduce your inventory relative to your cost of goods, and when you do that, that just means you're holding less on the shelf, so you may have to turn that over more times a year. Again, ideally, I think if you could get it, aside from somebody like an Amazon, you would like to see an inventory turnover of 365 that basically says we only hold 1 day's worth of inventory. And you do that, companies, you've seen a lot of companies that invest heavily, particularly lately, in improving their supply chain, meaning they are improving, they're shortening the amount of time that it takes for them to get new inventory to sell. If they're somebody that's just a wholesaler to retailer, or if they're in a production facility, if they make things, then they're trying to speed up, or I guess reduce technically the amount of time that it takes to make things, so that they need to hold less in inventory. So all of those are supply chain management. You do that to try and improve this number. Another sort of asset is your receivables. So accounts receivable, obviously. What you compare here are sales divided by accounts receivable. It's a very similar concept to the cost of goods. Remember, cost of goods are the cost of making the inventory. Sales are the stuff that you sell that if they didn't actually pay for it right then creates the accounts receivable. And so what you're asking is the number of times a year we collect our receivable amount. So again, keep in mind that firms tend to offer credit policies and credit terms that sort of state the desired time that they want. So let's say that you've got some firm that has a 30-day accounts receivable policy, basically 1 month. Then if 100% of their sales were bought on accounts receivable, then you would expect them to have 12 times the amount of sales as they have receivables. And or said differently, they'd have 1 month or 30 days of accounts receivable turnover. if they had much higher than that, you'd get worried because that would suggest that maybe they're not doing a good job of collections. But also keep in mind that for a lot of companies, not all of their sales are done through accounts receivable, and so you know, it wouldn't be surprising to have somebody that's got 90-day accounts receivable terms, as an example, let's say, or let's just use 30-day, but their receivable turnover ratio is way higher than 12. Maybe it's 24 or 36. And so if you were to divide that into, let's say, 36 into the days AR, you'd get a 10-day receivable turnover. And all that's really saying, it's not necessarily saying, wow, we collect really fast on our receivables. It potentially is just saying that only about a third of the sales that you make go to receivable. The rest of them are paid in cash, so they're cash sales. So really, to make sense of this in a useful way, you need to know a little bit more about the sales side of it and how much of it converts to accounts receivable or not. But it is, it is certainly indicative if the number's too high. I mean, if your days in accounts receivable are just, twice as much as your, as calculated here, twice as much as your credit policy says, then clearly that's a sign. And so if you want to improve this number, and improve it basically means we want there to be fewer accounts receivable for the sales, then you might reduce the AR terms or improve your collections so that you actually get the money collected within the term. Now, all of that said, understand that firms offer credit terms as a way of enticing customers to buy from them. So it is possible to have accounts receivable be too low relative to sales, maybe lower than your competitors, suggesting that maybe you don't have as good a terms as they have and you're losing some sales because of it. And so you want to be a little bit careful with this one because there's sort of a good side, bad side to it. That's all we have as it relates to the asset management. Hopefully that helps.